Welcome back. Welcome to Chapter 12. We're going to talk about how corporations are organized, stock transactions, and dividends. Stocks are always exciting, so are dividends. We love dividends. Okay, what is a corporation? A corporation, as you know, is a legal entity that is developed. It's a business, right? It's a legal entity. It owns its own assets, its own liabilities, its own equity. Think of a corporation as its own person. It's separate from the people that actually work in the business. It's its own entity. Okay. It incurs liabilities as it enters contracts. It owns its own assets. It owns its own property. The corporation is its own legal entity. And you can incorporate through the articles of incorporation, and it can be formed in a couple different ways. We'll talk a little bit about that. Most importantly, corporations can sell shares of its ownership. We call that stock. If you own part of a corporation, you own shares of stock. We'll talk more about stock. This is a characteristic that gives corporations the ability to raise a large amounts of capital or money, right? Got to raise money. How do you raise money? You sell part of the corporation through stock.
Yes. Yes. Yeah.
Good. Okay. What is a stockholder? A stockholder is somebody who owns the share of the corporation. And these shares can be bought and sold without affecting the corporation's ability to operate. For example, I own shares of Starbucks. Does that mean I own Starbucks? Kinda.
Yeah,
I own
you
a
are a
small part of
stockholder.
it.
You are a stockholder.
I'm a stockholder, exactly. I own shares of Starbucks. I don't own the company. I own shares of the company. I own a very small part of it. And I can buy and sell my shares of the company without affecting its operations. Corporations whose shares of stock are traded in public markets are called public corporations. These are companies that can be bought and sold their shares on the exchanges, like the NASDAQ, the Dow, the NYSE, and other various exchanges throughout the world. These are publicly traded companies. We call those public corporations. That would be companies like Starbucks or anyone else that is publicly traded. And you can find if a company is publicly traded by visiting sec.gov. That's the Securities Exchange Commission website, which is a government entity that provides information on publicly traded companies to private individuals, including all of their financial statements. Since it's publicly traded, all the information is made publicly available. Corporations who do not that are not traded publicly are usually owned by a small group of investors. We call these non-public or private corporations. A private corporation might be your local Chinese restaurant. It's privately held. It's privately owned by members of that family or small investors. It's private. It's a private corporation, which basically means it's not publicly traded. Stockholders of corporations have limited liability. What does that mean? Since I'm a stockholder of Starbucks, I can't be sued, okay, by somebody who's suing Starbucks. My liability is limited. If my liability is limited, I'm also limited to the losses. If I own shares of Starbucks and Starbucks goes bankrupt and they go out of business, I'm
Nothing
limited to
happens.
the loss. I'm limited to the amount I invested in that company. So in other words, I'll only lose my shares, and that's it. I won't lose
You won't.
tons and tons. Drew, does it make sense?
Yes, yes, it makes sense.
Perfect.
I have a question, Professor.
Yeah,
I'm
go ahead,
sorry.
Fritza. Go ahead.
Oh, I'm sorry. I thought Drew was still talking.
Yeah, I'm done.
Oh, okay. So my question is, I remember I was in middle school. There was a huge discussion about what's it called? It was this major corporation. It went belly up, and people was working. It starts with an E.
Enron.
Enron, yes. So I was young, and our teacher made us do current events in the morning. And one of my classmates did a current event on a financial portion of the newspaper, and he was just saying that Enron had it set up where the pension was also invested in stocks into the company, and a lot of people basically put all the eggs in one basket within that company,
Correct.
and there was some unethical things that was taking place at the top
Yep.
of the CEOs.
Very
And so
much.
when they got caught up, they got fined by the government, in which they basically, instead of them losing money, the employees lost money, and then they got laid off.
That's right. Yep. Yep.
So can you please explain that in regards to when you have money tied into your business of your place of employment?
Sure. So oftentimes corporations will provide shares of ownership within the corporation through stocks. This is a very common practice. Employees typically have the ability to either opt in or opt out of owning shares of the company that they work for. In that situation, those stockholders of the corporation of which they work for, they are common stockholders. Sometimes they're preferred stockholders. Usually preferred stockholders are people that work for the corporation. They own shares of stock, but they do not have a majority share. Those employees in Enron's situation, they were preferred stockholders that invested in their own corporation through purchasing shares of their own stock. Or in some cases, the company gives you shares of stock, which is sometimes could be a really nice perk. In the case of Enron, it's very unique because they inflated their books by making it look like their sales were really good, when in fact they didn't exist. Which increased the price of their stock, which made everything look wonderful. Then eventually the accounting fraud scheme caught up with them, and the company eventually went out of business. While a bunch of executives and CEOs went to jail, and the investors lost everything that they invested. So the moral of the story is, number one, never put all your eggs in one basket. Number two, if you're going to invest in any company, even if it's your own, make sure you understand the company's financial position by reviewing the 10-K documents filed on the Securities Exchange Commission website, and also by understanding the direction the company is heading in by listening to all communications issued by the board of directors. So that situation is very unique, but it does happen from time to time. So if you were to ask me, would you invest in your own company by purchasing stock within your company? The answer is probably no. I probably wouldn't do that. And the reason being is because you don't want to have all your eggs tied in one basket. The other thing that you would want to do is for your retirement portfolios to make sure that your portfolio is diversified. What does that mean? Making sure that your stock portfolio in your 401k or your 403b or whatever it is, that you don't have everything allocated into one fund. You want to make sure that's across multiple funds. And you can do that. You just have to contact the people that your retirement plan is with. You call them up and say, listen, I want to make sure that my stuff's diversified. I want to make sure that I'm not in one fund. You want to be in multiple funds. Reason being is because if one part of the market drops, the rest of it will be mitigated from that loss. Yep. It's called diversifying. You're having multiple funds is being diversified. What happened in the case of Enron is their employees had all their retirement in one fund. And that fund was run by Enron. And so when Enron went out of business, those people who had all their retirement in that one fund lost their entire retirement. So the moral of the story is diversify. Thanks for bringing that up, Fritz. I almost forgot about that case. Yeah, it's a good case. Okay, so board of directors. Board of directors are the people in charge of running the company. Those are typically appointed, selected by the CEO. They run the day-to-day operations of the business. Board of directors typically do not have voting rights. What do I mean by that? The board of directors typically do not have the ability to vote on the company's direction based off of the shares that they own. Okay, so here's the typical structure of an organization, of a company, a corporation. Stockholders are the people that buy and sell stock. Those are the ones that they have what we call voting rights. Voting rights tell the board of directors what to do with the company. So if you have voting rights in a company, you can elect the people to the board of directors, and you can also vote on proposals made by the board of directors. Stockholders are the people that guide the company. The board of directors is guided by the stockholders. The board of directors make proposals to stockholders. Stockholders vote on those proposals. Okay. Board of directors inform and guide the company through telling the officers or managers of the company what to do, right? This is how the company should be run. And then those officers, of course, guide the employees of the company. And this is the typical organizational structure of a corporation. Of course, some might look a little bit different, but this is the standard structure. As you know, the corporation operates as a separate entity and subject to its own taxes. These are corporate taxes that the corporation must pay. Those include things like federal and local state income taxes. Stockholders must pay income taxes based off of the dividends that they receive. So if you receive a dividend, like I know that Fritza does, when you receive your dollar here, dollar there, that's technically income to you. You need to pay income taxes that include those dividends. And there's typically a form that you'll receive from the IRS for that. Okay, how do you form a corporation? Well, there's a legal application that you need to file called the Articles of Incorporation. These are the laws that govern the corporation. Most corporations are formed in the state of Delaware and the state of Nevada. Reason being is because they don't have state income taxes in those states. Forming a corporation includes the Articles of Incorporation, which are the formal guidelines of that corporation, how it's established. There are a set of bylaws that are rules and procedures for conducting the business of that corporation. There are a lot of costs.
Two states again, professors? Delaware and what other state?
Nevada.
Nevada. Oh, so that's why there are a whole
That's
bunch
why
of
you see so many
billionaires.
corporations incorporated in both of those states, because there are no state income tax.
Now, do you think Colorado would ever become one of those states? I remember hearing something like that on CNN about certain states.
It is slowly, but I don't know. It'll never be as big as Delaware or Nevada.
Okay, thank you.
Yeah, absolutely. Costs include, obviously there's costs with forming a corporation. Those include things like legal fees, taxes, state and corporation fees, license fees, and promotional costs. So, for example, if I wanted to form a company in the District of Columbia. To do so, I need to file paperwork which are my articles of incorporation with the District of Columbia through the Commerce Department. As I file that paperwork, I need to pay taxes if I've already made sales. I need to pay the District of Columbia incorporation fees. It's like $30. Basically saying, oh, I'm going to start a business. Okay, I have to apply to start a business through the Commerce Department. I need to pay them the incorporation fee. It's like $30. Any licensing, if you need any licensing, like if you're selling tobacco, liquor, lottery, whatever, there's licensing fees involved. Any promotional costs, things like that, to get the business up and running. These are typical costs that will probably be incurred when you start your business. These costs are debited as an expense account, as you know, under organizational expenses. So if you start a brand new business and you need to pay licensing fees and all incorporation fees, all that type of stuff, you want to debit organizational expenses and credit your cash. And the title will be, or the note will be, paid costs for organizing the corporation. Typically, this is only done once, because you're only going to form the corporation once. There are two main sources of stockholder equity. They are called paid-in capital. These are contributions made by the owners, and retained earnings. Retained earnings, as you know, are funds retained in the business from year-to-year operations. We talked a lot about that in previous chapters. The main source of paid-in capital is from the issuance of stock. As a company issues shares of stock in exchange for cash, the company puts that cash into the paid-in capital account. What are characteristics of stock? Characteristics include the number of shares of stock that are authorized to be issued. The term issued refers to the shares issued to stockholders. Stock remaining on hand in the hands of stockholders is called outstanding stock. So if my company issues stock to stockholders, on my books it shows as outstanding stock. It's outstanding because the company does not possess that stock. The stock is with the stockholders. That's outstanding stock. So here's a nice little graphical representation. Authorized shares are the shares that I can distribute to stockholders. The issued shares are the stocks I've issued to the public. The outstanding stock are the stock that the public holds. Okay, a couple definitions. Par value. Par value is the amount of shares of stock that are often assigned a dollar amount. That's par value. Par value basically says, what is that stock worth? That's par value. Stock issued without par value is called non-par stock. Sometimes that's given to board of directors. It's rare, but it happens. To protect creditors, some state laws require corporations to maintain a minimum amount of paid-in capital. This minimum amount is called legal capital, and that depends on the jurisdiction of the business. Major rights to company ownership of stock include the right to vote in matters concerning the corporation, the right to share in distributions of earnings, and the right to asset upon liquidation. What does this mean? If you own a share of stock, you can vote on issues that concern the corporation to the board of directors. You have the right to receive any distributions of earnings that are issued by the company. And those are in the form of dividends, by the way. And you also have the right to share in assets upon liquidation. If the company goes out of business, after the creditors are paid back, if there's anything left over, it gets distributed among shareholders. There are two very common forms of stock. One is called common stock, and the other is called preferred stock. Common stock, it's common. It's common. It's issued. Common stock is where each share of common stock has equal rights. It's common. Common stock is what you would typically buy off of the exchanges. Then there's what we call preferred stock. Preferred stock is when the corporation issues one or more class of stock with preferred rights, such as dividends. We call this preferred stock. Dividend rate of preferred stock are stated as either dollars per share or as a percentage of par. We'll talk more about that here in a second. Preferred stockholders have the first right, which is called preference. That's why they're called preferred stock. And thus they have a greater chance of receiving dividends more than common shareholders. However, dividends are normally based off of earnings. A corporation cannot guarantee dividends to preferred shareholders. Dividends are authorized by the corporation's board of directors. When they're authorized, we call that a declaration or a declared dividend. Cumulative preferred stock has a right to receive regular dividends that were not declared in prior years. Non-cumulative preferred stock is when they do not have that right. When you see the word in arrears, it means that you have the right. It means that cumulative preferred stock that have not been paid in previous years is called in arrears. In arrears basically means that you have the right to collect the dividend on that stock for previous years. It accumulates over time. It's in arrears. It means that it's accumulated but has not yet been paid. In arrears. Any preferred dividends in arrears must be paid before common stock. Any dividends in arrears are normally disclosed in the notes of the financial statements. Here's an example. Let's assume we have a corporation that issued 1,000 shares of cumulative preferred stock at $4 per share with $50 par value, and 4,000 of shares of common stock at $15 of par value. The corporation was organized on January 1st of year 1 and paid no dividends in year 1 and year 2. In year 3, the corporation paid $22,000 in dividends, which was $12,000 to preferred stockholders and $10,000 to common stockholders. Here's how it looks. Company paid out total $22,000 of shares. Year 1, 1,000 shares at $4 per share, 4,000. Year 2, 1,000 shares at $4 per share, 4,000. Year 3, 1,000 shares, $4, 4,000. Gets you up to 12. Total dividends paid was $22,000 minus the $12,000 gives you $10,000 that was paid to the common shareholders. Now remember, your preferred shareholders are paid before common shareholders are. So if the company decides to pay out dividends, the preferred shareholders will receive the dividend payment before the common shareholders will. So as a result, preferred shareholders receive $12 per share, and the common shareholders receive $2.50 per share. Your book has a lot better examples. Just for time purposes, we're just going to go through. In addition to dividend preferences, preferred stock may be given preference if corporation goes out of business. However, claims of liquidators must be satisfied first. In other words, company goes out of business. First, the creditors get paid back. Then, if there's anything left, preferred stockholders get paid. And then, if there's anything left after that, then the common stock shareholders get paid. It's in real life, it's rare that anyone gets paid. Okay, issuing stock. A separate account is used for the recording of the amount for class stock issued in the common stock. Okay. Here's an example. Let's assume the corporation authorizes 10,000 shares at $100 for preferred stock and $20 for common stock at 100,000 shares. The corporation issues 5,000 shares of preferred stock and 50,000 shares of common stock to raise cash. The company receives $1.5 million in cash. We issued $500,000 worth of preferred stock, and we issued $1 million worth of common stock. How we got there? As we mentioned, $10,000. 10,000 shares at $100 per stock gets you, and $20 at 100,000 shares. And of course, as you know, 5,000 shares and 50,000 shares, respectively. Stock is often issued by a corporation at a price other than its par value. The difference is very similar to what we learned.
Professor, I'm sorry, I'm gonna have to leave the class. A family member just got to a bad accident. I have to go.
I understand. Good luck, Fritza. Okay. When there's a difference, price is sold depending on the various factors. Financial condition, earnings record, and dividends of the corporation. Investors' expectations of the corporation and potential earnings power, and general business and economic conditions and expectations. In other words, the stock price will change based on a number of different factors. The financial condition of the company, investor expectations, and general business and economic conditions. Those are the many reasons why you see that stock prices change every single day. And of course, the other reason is that investors are commonly buying and selling stock at an exponential rate. Now, here we go again. This you remember from the last chapter, premium and discount. The same concept applies to stock as it does to bonds, premium and discount. If the stock is issued for a price that is more than its par value, the stock is sold at a premium. Think of par value as the market value. Okay. If a stock price is sold less than par value, it's called a discount. Again, very, very similar to what we learned about in the previous chapter. When stock is issued at a premium, cash is debited and the common stock is credited, or preferred stock is credited. The difference here is an account called paid in capital in excess of par value. That's the name of the account that's used when there's a premium. Here's an example of that. We issued 2,000 shares at $50 per share for preferred stock. So we debit $110,000 for cash. We credit $100,000 preferred stock, and a paid in capital in excess of par to record the premium of $10,000. Why is that? Because the par value was $55. So there's a $5 difference per share. When a stock is issued at an exchange to assets other than cash, such as land, value, or assets, we record that based on market value. So that rarely happens. Really rarely happens. When it does happen, so in other words, let's say one of the investors gave us land instead of cash, we debit the land account, and we credit the common stock account, and then of course the difference based off of the share price. No par stock. This is when there's, kind of like an even exchange. Cash debit, common stock credit. We issue it at the face value. Okay. No par. Okay. Dividends. Oh my goodness, dividends. I love dividends. When a board of directors declares a dividend, there is a date that is set that the dividends will be issued. Well, there's a couple of dates. The first date is the declaration date. That's when the board of directors says, okay, we have agreed, we're going to pay a dividend. That's the declaration date. And then they'll set the amount and they'll set the date that it's supposed to be paid to the shareholders. Cash dividends. Cash dividend is when there's a cash distribution of earnings to the stockholders. Dividends may be paid in other assets, but cash is most common. Clearly, I'm not going to issue a piece of equipment. I'm going to issue cash, right? Okay, so there's three situations that happen when there's a cash dividend. Number one, there has to be a good amount of retained earnings. Number two, you have to have enough cash to pay. And number three, there needs to be a formal action by the board of directors. They have to vote on it, right? You have to have enough retained earnings. You have to have enough cash on hand, and the board of directors must say that we have the ability to issue a cash dividend. That's basically what that says. Okay, so here's what it looks like. When the board of directors issues the dividend, there's a date of declaration. That's when the board of directors say, okay, we can pay a dividend. The second thing is the date of record, when that dividend is going to be paid out, or when we've just made that decision. The third date is the date of the payment, when we're actually paying the dividend to the shareholders. Date of declaration, that's when the board of directors says, hey, we're going to issue a dividend. Date of record is when the corporation uses to determine which stockholders will receive that dividend. That's the date of record. During the period of time which the date of declaration is recorded, the stock price is quoted with dividends. Date of the payment is when the corporation will actually pay the dividend to the stockholders. The price of which is being paid out, we call that ex-dividends. Ex-dividends. Okay, let's see a quick example. October 1st, the company declares the following dividends of the date at which November 10th and December 2nd will actually be paid out. Preferred stock, $2.50. Common stock, 30 cents. These are the dividends per share that are being paid out. We take the total of number of shares outstanding times the dividends being paid out. Total amount outstanding times share being paid out to give us a total dividends being paid out. And of course, here are the journal entries that we make. Debit cash dividends for cash coming in. Cash dividends payable, we credit. Again, payable, increased payable, we credit. That's at the time that we've identified when we're going to pay it out. No entries made at the date of record. On the day that we're actually paying it out, we debit cash dividends payable and we credit the cash to represent the cash that we're paying to our stockholders. Let's talk quickly about stock dividends. So instead of a cash dividend being paid out, we could pay stockholders with additional stock. This is often commonly done when there's a stock split as well, and we'll talk a little bit about that here soon. So instead of me saying, hey, I'll pay you 30 cents for that share of stock you own, I'll pay you with additional stock. Stock dividends are normally declared on common stock that's issued to common stockholders. The effect on this is that basically instead of me saying, I'll give you 30 cents every 6 months or 3 months or 6 months for that stock that you own, I'll just give you another share of stock. We do that, what's called a stock dividend. This specifies the amount of stock dividend transferred from retained earnings to paid capital. Illustration of that is the par value of the stock, the number of shares I'm issuing. So par value times number of shares being issued. Paid in capital excess of par is 9 million. How we got there? That's the difference between the par value and the share per stock. And of course, retained earnings. And this shows how this stock is recorded. So we debit stock dividends, and we credit stock dividends distributable, and we credit paid in capital. In this example, January 10th, the stock dividend is distributed to shareholders by issuing $1,000 shares of common stock. So we take the 1,000 shares of common stock and we multiply that by the stock value to debit the stock dividends distributable and credit the common stock. Stock dividends do not change the assets, liabilities, or equities of a corporation. So in other words, when there's a stock dividend that's paid, all we're doing is we're increasing the amount of our equity, right? By increasing the amount of available shares. So it doesn't really have an impact on the accounting equation. We're essentially diluting the number of shares that are outstanding. When you hear the word dilution or diluting, it means we're adding to that number of shares, or we're adding to something, we're diluting it. It's the same like when you dilute something with water, like you use a chemical solution, you dilute it with water. All you're doing is you're weakening it, right, by adding more to it. The same concept applies with stock. When I issue more stock, I dilute the value of each stock. That's just an example of that. Stock split. Okay. Recently, you probably heard in the news, I believe it was both Amazon and Apple had a stock split this past year. When that happens, it dilutes the stock by splitting the stock. What does that mean? You once had one share of Apple, you now have 2 shares of Apple, but they're worth the same value. So instead of it being $100 per share, it's $50 for 2 shares, right? Stock split. Stock split applies for all major shares unissued and issued. The reason why we do this is to reduce the market price of per share of the stock. It attracts more investors. So if Apple had $1,000 per share, if we do a stock split, it brings it down to $500 per share. Instead of that one stock that you owned, you now have 2 stocks, but it's worth the same amount. The reason why companies do that is to attract new investors. And I just gave you a good example, a more current one. This is what it looks like visually. Before the stock split, you had 4 shares at $100 per share. After a stock split 5-to-1, you now have 20 shares at $20 per share. We see that they're both equal. The difference here is that I'm reducing the total value per share, but increasing the number of shares. And again, the whole concept is to attract new investors. Now let's quickly talk about treasury stock. Treasury stock is stock that the corporation has issued and then reacquired. In other words, I issued out shares and I bought back those shares. The company bought back the shares. That's called treasury stock when that happens. The reason why companies do this is to raise the value of each share outstanding. It provides shares to resell to employees. It also provides a bonus to employees and supports the market price for each share of stock. We use the cost method for this. Treasury stock is debited, and then of course we credit the cash. This just kind of illustrates how all of that works. Not a whole ton to know there. On the balance sheet. As you know, on the balance sheet is where you'll find your stockholders' equity. There's two methods for stockholders' equity being recorded. The first one is each class of stock is reported and is related to the paid in capital accounts. The second method is where the stock accounts are reported and followed by paid in capital. So let me show you what that looks like. On the stockholders' equity, under method 1, you can see how it's broken out. You have preferred stock, any excess, common stock, any excess, and then of course treasury stock, and then you got your retained earnings. That's one method of reporting it. Another method is more condensed. You see that you have your preferred, your common, additional paid in capital, and retained earnings. So most commonly, the second method is used. Basically, all this shows is that the lines are condensed. Yep. This makes it easier for reporting. Significant changes may occur throughout the period, and as you know, those changes get reported on the stockholders' equity report. Reporting retained earnings. I'm sorry, I meant to say the retained earnings report. The report for retained earnings represents changes that may have occurred throughout the period, and the reason for changes include separate reports, combined income, retained earnings, or a statement of stockholders' equity. Basically, all this says is that we can report it a little bit differently to show those changes a little bit simpler through the retained earnings statement. And you've seen this before. The retained earnings statement shows your beginning balance retained earnings at the beginning of the year, your net income minus any dividends gives you the change in retained earnings to get to your retained earnings at the end of that respective accounting period. There are restrictions involving stock. Restrictions are sometimes called appropriations, and it's a part of the retained earnings. Restrictions are basically just they limit the way that dividends can be paid out. And those are disclosed in notes through the financial statements. An example would be for legal reasons, contractual reasons, or discretionary reasons, why there might be restrictions in place for the issuance of stock. Prior period adjustments. This happens when there was a change in stock from the previous period that were not yet recorded. We would make those changes in the retained earnings. We call it prior period adjustments. There's also a smaller accounting statement called the Statement of Stockholders' Equity. And this shows us changes in stockholders' equity over time. The Statement of Stockholders' Equity is normally prepared in a column type of format. The stockholders' equity classification. And then, of course, it breaks it out into each type of classification: preferred, common, additional paid in capital, retained earnings, treasury stock. And then we spread that over time. Last formula you need to know. Earnings per common share of stock, or also known as earnings per share. Earnings per share represents basic earnings power. This is where corporations whose stocks traded publicly must report earnings per share on their income statements. Earnings per share basically tells us what each share is worth. To calculate that, we take our net income, subtract out preferred dividends, and divide that by the average number of common shares outstanding. To get your to show you what that looks like for this company, you got your net income, average number of shares outstanding, and which gives you your earnings per share. You take your net income divided by average number of shares outstanding to get your earnings per share. And that is the end of the chapter. Are there any comments, questions, or concerns I can help to answer for chapter 12? We're good? You sure? Stop sharing my screen now. Are there any comments, questions, concerns that I can help to answer at this time? For anything at all? Anything at all? No? Really? Drew, you're on mute, my friend. Are you saying something? Hold on just a sec. Let me get you. Go ahead, Drew.
Yes. When are we going to physically be in class again?
I'm sorry?
When are we going to be in class again? I mean, physically.
Physically? That's a wonderful question. I don't think anyone can answer that question at this time. I hope that it's somewhat soon. My guess is, if I had to guess, it'll probably be toward the end of spring. End of the spring semester. That would be my guess. Again, it's we haven't had any communication from the university leadership yet on when we'll be returning to the campus. My guess, if I had to guess, it would probably be sometime in the spring.
All right.
But all that's going to depend on when there's a vaccine made widely available.
All right.
So that's the unfortunate reality of what everyone's dealing with. So, but hopefully it'll be next semester.
All right.
So good question. Any other comments, questions, or concerns I can help to answer? Everyone's good? Okay. Well, again, if you ever need anything, you ever want to talk about whatever, you know how to get me. My cell phone number is in the classroom under my contact information. You can schedule office hours with me, and of course, you can email me.
Okay, wait, one more thing.
Yeah, go ahead, Drew.
Was it a personal financial plan?
Personal financial plan. I can help you with one if you need.
Yeah, well, no. I mean, I think that was for principals. Like, this is principals accounting, right?
So personal financial plan is probably in your personal finance class with Professor Pearsall.
Yeah, well, that's must have been. I was thinking about just.
Yeah, no problem. Yep.
Just wondering.
Yeah, no
Thank
worries.
you.
Don't have to worry
Have a
about
good
that here.
Right.
Okay, so if there's nothing else, love to call it a meeting, and I hope you all stay well, healthy, wash your hands as much as you can, stay safe, and I'll see you all again this coming Tuesday. In the meanwhile, make sure that if you're missing any work, or if you are you have your homework for chapter 11, I believe, is a discussion board, and chapter 12, I think, is a quiz. So I'll look forward to seeing your work.
Thank you.
All right. Thank you, everyone. Take care. Have a great day.
You too.
Thank you
Thank
so
you,
much.
Professor.
Thank
Have a good
you.
one.
All right. Bye-bye.